Hi, I'm ALICIA SEIGER, Managing Director of the Sustainable Finance Initiative at Stanford University and a member of the Ceres Board of Directors. In this session, Achieving Paris-Aligned Investment Portfolios, we will examine the commitments large institutional investors are making to transition their investment portfolios to net zero emissions by 2050 or sooner. We will learn about the actions investors are taking to implement their net zero commitments, including setting up intermediate targets and developing robust investor climate action plans, and explore the opportunities for investors to join forces with the growing number of companies, governments, and other stakeholders committed to making a just transition to a net zero emissions economy. Let's welcome our speakers: AUDREY CHOI, Chief Marketing Officer, Morgan Stanley; WENDY CROMWELL, Director, Sustainable Investment, Wellington Management; Tony Davis, CEO and CIO, Inherent Group; New York State Comptroller, Tom DINAPOLI, sole fiduciary of the New York State Common Retirement Fund; and Marcie Frost, CEO, CalPERS, the largest U.S. public pension fund.
I'm delighted that you're all with us today. This is going to be an exciting conversation about investors who have made commitments and the actions that they're really taking. Let's just jump right in. I'll start with Marcie.
So Kirsten, thank you for that introduction. Again, I'm Marcie Frost. I'm the CEO at CalPERS. And the reason that CalPERS joined, in September of 2019, we did set a target for net zero emissions by 2050. And that commitment really is around achieving an overall balance between emissions produced and emissions taken out of the atmosphere. Our platform is really around advocacy, it's our policy work, it's integration. And on the advocacy side, we have been engaging with policymakers here in the United States. We're certainly engaging with companies. We're integrating sustainability into all of our investment decisions here in Sacramento, and working with many of our manager partners. And that commitment in 2019 is really to recognize the need for early action. And we also intend to capture those opportunities that could be created by a net zero transition. We often get into this debate about who's providing capital to particular companies, and I really do think it's less about who's providing capital and having that seat at the table where our voice continues to matter, and also finding those opportunities to fund that transition while we're also meeting the need that we have for risk-adjusted returns. So that's why in September of 2019, we really committed to taking additional action and really making our voice more globally heard. We believe that to do an appropriate transition by 2050, there's a significant amount of work ahead, and CalPERS cannot do that as its own. We're certainly a large portfolio. We sit at roughly $450 billion today, but we have to rely on our partners. We have to rely on other asset owners, other asset managers, governments, regulators, policymakers, in order to make this truly sustainable, and that it's more about action. We're very concerned about the perception of greenwashing our portfolio, and the way that we really cut through that type of perception is to make sure that we're taking appropriate actions along with other global investors, other global policymakers. It's also one of the primary reasons that we co-founded Climate Action 100+, an extremely important engagement, and we're seeing significant results there. So our plan around getting to net zero by 2050 really starts with understanding the risks that we have in our portfolio. And one of the top 3 risks that we've identified for CalPERS and the portfolio, and remember, we're very long-term investors. We've made commitments to almost 2 million members here in the state of California that their benefits will be here over the long run, over decades, that we are an evergreen system. And so everything we do has to be mindful that the risks of tomorrow have to be realized today, and the earlier we take that action, the better that we can mitigate those risks. So for us, corporate engagement has really been the key. The primary channel for corporate engagement for CalPERS has been through Climate Action 100+, and I think we're getting some really strong results. We have shown that 50 of the companies where engagement has been active and engagement has been successful have now set net zero targets. And these include companies like PetroChina, Shell, BP, Duke Energy, which is the biggest utility here in the US, and then Japanese manufacturers like Hitachi. So we've also launched a benchmark that can help us track our progress, as well as holding these companies really accountable to the commitments that they've made. We know that our advocacy role is extremely important here in the US with regulators and policymakers, but also really around the globe, pushing for carbon pricing and emission standards here in the United States at the SEC, and then internationally at IFRS. And anytime it is a global effort, there are certainly challenges through regulatory bodies that are not your own, through policymakers, which are not ones where you have any influence over, or sitting here in the state of California, where we want it to be an early adopter, an early mover, just keeping our membership, our 2 million members, completely in a place where they understand why we're taking the actions that we're taking with the portfolio, that we are about managing this risk, get appropriate returns, and being able to pay these benefits to these 2 million members, these public servants who've worked a very long career in public service here in the state of California, that they have a benefit that they can rely on throughout their lifetime. A few elements of our action plan would be the issuance of our first TCFD report. We believe that if we have expectations of other companies, that we need to have those same expectations for ourselves. So we did release our TCFD report. It is available on our website. We're certainly not at a place in scope 1, 2, 3 emissions that we would like to be.
Hi, I'm New York State Controller Tom DiNapoli. I serve as trustee of the New York Common Retirement Fund. We're the investment fund that provides the money to pay for the retirement security of 1.1 million New Yorkers who are part of our retirement system, public employees and retirees and their beneficiaries. Well, we were very pleased to announce that goal. I think it continues the leadership that we've tried to provide on the issue of addressing the risk of climate change from the investment and investor perspective. It really builds on the work that we already had underway to be supportive of the goals of the Paris Agreement, because we think that those goals are important for the planet to survive and for the global economy to survive as well. So in announcing that net zero emissions goal by 2040, we're really expanding the work that began with our climate action plan, which is really a multifaceted approach to dealing with this issue. So it certainly includes advocacy on a public policy perspective. It includes engagement with the companies we invest in to press them as far as disclosing their greenhouse gas emissions, disclosing how they are having their business plans comport with the goals of the Paris Agreement, and pressing them if they're not taking actions consistent with our objective to do that. And making an evaluation really of, if you will, the corporate culture and the corporate priorities, and perhaps in the most extreme cases, choosing to no longer invest with certain companies. And then parallel to that is seeking out new opportunities. So climate change is a material risk to the portfolio, but there are also great opportunities in the emerging lower carbon economy that we want to be positioned to take advantage of. So we also have developed an allocation in our portfolio of $20 billion to source out climate solutions, sustainable investments. We've already deployed a significant amount of that capital, but not all of it. And we've hired dedicated staff to be focused on sourcing out those sustainable and climate solution investments. So, you know, I think it's a holistic approach, one that I think will position the fund effectively for the future. And it really gets that question of de-risking our portfolio. Climate change is a risk in many different ways, but certainly it's an investment risk. And we want to de-risk the portfolio. We do that by pressing companies to be in conformance with the goals of the Paris Agreement. Hence that goal of 2040, which I know is a little more ambitious than what some other investors have aspired to. But you know, we're seeing many of the larger corporations, even in this country, commit to 2050 net zero. Some also 2040. We'd like to see more of the U.S. companies catch up to their European counterparts, but certainly that's where we hope that our work as an investor and a large investor will help to change the dynamic in many of the corporate boardrooms where we'd like to see them take a bit more seriously being supportive of the goals of Paris. Well, as you know, we implemented our climate action plan in 2019, and I think it's important to point out that that plan was an evolution of work where we had convened a panel of experts with an advisory panel to really look at the work that we had done thus far and what more could we do. And again, to deal with this issue from the perspective of what is the risk to our investments, what's the risk to the portfolio. So the Climate Action Plan has many different elements to it. It underscores the continuing importance of engagement to try to press corporations to do the right thing, for us to play an active role in terms of public policy advocacy, whether that's legislative or regulatory, to look at proactively investing in terms of being part of the emerging low carbon economy, look for climate solution investments, and perhaps in some cases, pull out our investments to do some level of divestment. But what was helpful about what the advisory panel recommended, and what is really the foundation to our climate action plan, is to say that we are going to assess our investments in our portfolio companies from the perspective of what is their transition readiness. Are they making the decisions and the choices to position their company for the future, to be have a sustainable business model? And we believe strongly that showing that you are ready for the transition to the lower carbon economy, developing business plans that are consistent with the goals of the Paris Agreement, and much of that starts with disclosure of greenhouse gas emissions and other environmental imperatives, because data becomes very important in terms of the analysis that we're making in terms of transition readiness, because that information helps us establish what we call minimum standards. As a pension fund, we're risk averse. We have 1.1 million New Yorkers and their families who depend on our decisions for their retirement security. So we take very seriously the choices we make from an investment perspective, and we want to do right by the climate issue. Of course, it's important to the global economy if we're going to have any viable investments out there. But we still have short-term goals of making sure that our portfolio is providing the expected return within reasonable risk. So trying to source out on the passive investment side opportunities that meet our goals, that have some kind of a track record, and incorporate a forward-looking view of how the economy will transition with the goals of Paris in mind, that's still a work in progress.
I'm Audrey CHOI. I'm the Chief Sustainability Officer and Chief Marketing Officer at Morgan Stanley, and I'm also the CEO of the Morgan Stanley Institute for Sustainable Investing. And we were very excited to be able to be the first major US bank to commit last September, to become net zero by 2050. What this means is that we will be reducing the carbon emissions of our finances across the business to net zero by 2050 in alignment with the Paris Agreement. And of course, we'll also be working actively with clients and partners as they embark on the journey to transition really to a lower carbon economy. Back in 2009, when we founded our Global Sustainable Finance Group. This was, frankly, way before our Wall Street peers were looking at sustainability as a part of the business. We really declared as an article of faith back in 2009 that sustainability was a core part of business and a core part of investments, and that we fundamentally believed that we had an opportunity and an obligation to think about how could we harness the capital markets to really be aligned with protecting the environment, strengthening communities, and creating opportunity. We've always believed in the centrality of climate change as a massive influence on everything, on investing, on business, on markets, on return, on risk. And, we actually publicly supported the US joining the Paris Agreement before the Paris Agreement was actually even, inked. And we were very supportive of remaining in it and have always consistently been, because we really do fundamentally believe that at this point, it should be abundantly clear to everybody that climate change is the single most massive megatrend affecting investments, business, corporate strategy, communities, and really all of us. So it was really just the logical extension, the next step for us to say that we are making the commitment to align our business with the goals of Paris. So we think that ultimately this journey for all of us is going to be about the coming together of disclosure, transparency, standards, metrics, and real progress, all put together, hopefully in a scaffolding where there's shared agreement about what it means to get to net zero. As we look to implement this commitment, for us, one of the most important aspects of it is really about how do we do this together in an infrastructure that provides clarity and transparency and a commonality of language, of standards. So that was one of the reasons why we were so excited to join the Partnership for Carbon Accounting Financials last summer. We were the first US bank to be able to join PCAF and the only one invited onto the steering committee. And we believe that it's critical for us all to really agree on a shared way of thinking about carbon emissions so that we can really have comparability, transparency, and ultimately drive towards real accountability for all of us collectively. This is one of those areas where this is not about competition. This is not about trying to have our own proprietary exclusive way of doing this. We all are best served if we can come together with a common standard that really gives people transparency and accountability. It's also one of the reasons why we are very focused on standards. We really believe in, we've been a long supporter of the Sustainability Accounting Standards Board. I've had the pleasure of serving on the SASB board for the past number of years, along with other Morgan Stanley board members as well, Bob Hers, Mary Shapiro, who is the vice chair of SASB, as well as TCFD. And all these things need to ladder together so that we have a real robust infrastructure around accounting, around disclosures, around transparencies, and ultimately around how do we collectively get to net zero in a way that is really meaningful for the planet. No one necessarily has all the answers, but we've never done anything in the history of humanity, right, without first declaring intent. And this is a time where it is unquestionable that we need a bold declaration of intent, because then and only then can we marshal all the resources to get there collectively. Our analysts at Morgan Stanley Research have estimated it's going to cost tens of trillions of dollars of investment to really make this pivot as a global economy. But the great news is that also is opportunity for growth, for innovation, for job creation, and ultimately a more sustainable environment and economy, hopefully globally. It's very clear that climate action is going to require coordinated action, not only from finance and corporates, but also from policymakers globally. And this is an area where we really need to think about how can all of those things be pulled together so that we are really driving in the most efficient, smartest, and in this case, fastest way towards dramatic action on climate change.
It's great to be here with you today. My name is Tony Davis. I'm the CEO and founder of Inherent Group, which is a sustainability investment firm that invests across the equity and credit markets. We've committed to be net zero by 2050 in our operations and in our portfolios. On the former, we're already there through our actions. On the latter, frankly, we intend to get there by 2040 or earlier. And we've committed to being at least 50% of the way there by 2030. We made it because we felt like it was a call to arms and that we cannot sit back as investors and ask our companies to make these commitments and policymakers to move on the topic, but that we as investors, starting with our own operations, but clearly our portfolios as well, that we need to make progress. And it's our view that by doing so creates a virtuous circle when investors are moving in this direction and making statements of intent. Businesses are doing the same. Policymakers are making progress in their own domains. That this opens up space for each of us to continue raising the bar, and that if action is occurring in just one of these domains, we're going to be less likely to succeed and meet the goals of the Paris Accords. And this is how a movement begins, in our opinion. And let me start sort of first with, our desire is that this really has real world, real economy impacts. So number one, we need to engage with our companies. We are already doing so, but we're going to step up our efforts to engage with our companies, to put pressure on them to, number one, disclose what their carbon emissions are today, starting with 1 and 2, but we'd like them to be working on a path to disclosing scope 3 emissions. And separately, they need a plan for how they're going to reduce emissions over time. So that it all begins with this, and we need to work with our companies as a partner and give them the support as an investor that will be there with them through this journey and support them. So that's one way to get there. The other way to get there is for us to invest in businesses that are providing solutions, which we do today, which are going to be a critical part of us being able to meet these goals. And then ultimately, we're going to have to divest some of the businesses that are not on this journey and are not taking up the challenge to lead in this area. So those are really the three ways that we sort of see that we can reduce emissions in our portfolios. Just start by disclosing, what it is that you view as material. And in our case, on this topic, it's going to be scope 1 and 2 emissions. Tell people, what your plan is for reducing them, and then be transparent so that others can hold us accountable. Yeah, I would say on the solutions investing, we don't want sort of folks to use their scope 3 reductions as an excuse not to work on their scope 1 and 2 emissions, right? But at the same time, we really want to encourage some of the solutions businesses. Think about EVs, for example, that in some instances can have scope 1 and 2 per unit volumes in excess of legacy internal combustion engine OEMs. But we really want to invest and lower the cost of capital of those EVs that are going to lead, EV companies that are going to lead in providing clean transportation as a solution. We are, in the first instance, reaching out to each of our portfolio companies and letting them know that they need to disclose scope 1 and 2. As I said earlier, with the larger companies, this often is not as much of a challenge. With some of the middle market companies, some of our private equity sponsor-owned businesses that only have bonds, perhaps high-yield bonds or levered loans in the marketplace, are not disclosing. So really reaching out to those and letting them know if they don't disclose, either we'll vote against directors in our proxies, or we'll be forced to divest. So we can't, of course, meet this goal or even track and measure how we're doing if we don't have disclosure from our underlying companies. That seems very fundamental and basic to me. Number two, we are going to ask them to have their own plans for reducing emissions. So that's how we engage with our companies. On the other issues of solutions investing and of divestment, those are topics that we'll take up more internally in our portfolios in terms of how we're going to treat those activities in meeting our goals. And then ultimately using offsets as needed to finally get to our goals. And it's important that there are milestones. So we've talked about 2030, but we want to track our measurement and progress on the way to 2030, not wait till 2029 to figure out, how are we going to get there, and we're going to need a lot more offsets than we thought. We really want to be tracking kind of year in, year out and reporting out to our investors how we're performing.
So at a high level, the commitment is to support net zero greenhouse gas emissions by 2050, in line with efforts to limit global warming to 1.5 degrees Celsius. Now, as an asset manager, there are a number of different commitments, sub-commitments that we're making in order to support the overall commitment. The first is to work with our asset owner clients to support their goals, their decarbonization goals, with that ambition to be net zero by 2050. The second is very specifically by November of this year, around the time of COP26, to announce our initial and interim AUM target for funds and strategies that are aligned with the goal, and that also have an interim target of 2030, 50% reduction in CO2. And then last but not least, we've committed to review our internal target on both of those fronts, the AUM and our progress against the objective, at least every 5 years. But of course, we have the intention to do that much more frequently. Back in September of 2018, Wellington formed a partnership with a climate science group, Woodwell Climate Research Center, to try to bridge the gap between physical climate science research and finance. And I think that was a critical underpinning to our rationale for signing this commitment. We have studied with those scientists the impact of heat, drought, wildfire, hurricanes, floods, access to water issues on capital markets. And we've become really compelled and convinced that these impacts are going to be significant and severe and earlier than many people understand. And so once our investors have taken that on board and understand the consequences of physical climate risk, we understand the need for adaptation, and then we also understand the critical need for mitigation. We also recognize that the energy transition is unfolding and it's not going to go back in the other direction, and that we need all of our companies and securities that we invest in to have credible energy transition plans, or else they're not going to be good investments. And certainly they're not going to contribute to the decarbonization of society as we need it. In terms of implementation, we think that you need to have a multi-factor strategy. And one of the strategies that we intend to employ early on is to use our size. We're a $1.3 trillion AUM asset manager. Our active nature, so we make active buy and sell decisions. So we have some influence over companies because they'd rather us buy than sell their securities. And then the fact that we have these credible, really long tenured industry analysts that have relationships with management teams or just a good understanding of their industry from having covered it for 20, 30 years. Use those characteristics to our advantage to influence companies to adopt science-based targets. And so some will think, oh, when you sign up for a net zero commitment, you're really thinking about divestment. But to us, divestment may decarbonize your portfolio, but it's not decarbonizing society. And so therefore, you're not actually insulating your portfolio from climate risks, because those physical climate risks that I spoke about earlier are still going to exist. So the best case scenario for everyone is for us to see how many companies we can get to have credible energy transition plans through science-based targets, which would lead to a great opportunity set, better resilience and adaptation in the economy, lowering of overall emissions, and better long-term returns, because you won't face as much of a systemic challenge to finance or society. One challenge is the fact that there isn't methodology for all asset classes. But that actually compelled us to be part of the initiative because we want to be part of the group that is defining that methodology and work together with others on the best and most credible way to do so. The second is people will say we don't have all the data that we need, or scope 3 measurements are all estimated. Again, we think that it's critically important to get started. We have built into our dashboards scope 1 and scope 2 data, and then estimated scope 3 emissions, with the understanding that those data will improve over time. And it is a 30-year commitment. And by making the commitment, we will help to ensure that those data improve over time. And then the last thing was, I encourage other asset managers who are interested in doing this to do some spreadsheet work. Asset managers are inherently analytical. We don't want to make commitments that aren't credible or that we can't back up. So we actually put a lot of our funds into a spreadsheet. We modeled out hypotheticals about how they could make these commitments over time. We looked at which funds were already where they needed to be with regard to the 2030 commitment, which funds could, how many security names within certain funds had already made science-based target commitments, what that progression might look like over time. So some what if scenarios. It gets you more comfortable about what the path will be. And it helps, I think, at the management level and at the investor level to increase adoption. I think from a capital markets perspective, the next 5 years are going to be really transformational. And I think understanding that and leaning into that and trying to research that and be a part of it is going to be an incredible strategy for both adding value and changing the trajectory of these systemic risks.
Thank you for being with us. As you heard from our panelists, now is the time. Working together, we can set alignment with the Paris Agreement, set our own net zero targets, issue climate action plans that make transparent the ways that we're working on these issues together and make progress. We're going into the COP26 with policymakers, and they're going to be looking to see how fast, how deep is investor action around the world, and how does that align with the actions that we're calling for from our policymakers and regulators. The Paris-aligned investment initiative is a chance for investors to come together globally and work on these issues, learning as we go. We don't have all the answers. As you heard from our panelists, there's a lot of work to do together. I want to just note that our work on climate action plans, our work on setting targets, our work on developing the methodologies and the right ways of engaging, all of that comes within the purview of the Investor Agenda. So you can see some of our work on theinvestoragenda.org. But we're really happy that you've joined us today, and we welcome ongoing dialogue and conversation as we move this work forward.